breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
Live from New York City this morning. Good morning. Good morning to NVIDIA in the pre-market, higher by 28%. New session high for that name, absolutely flying. Lisa's going to build on that in just a moment. This is what it means for equity futures. They're flying too on the Nasdaq 100, up by 1.9%, adding to the gain so far this year. The Nasdaq, of course, with a 5 to 6% weighting for NVIDIA, which explains why you've got this move on the Nasdaq 100. This is going to breathe some life into the other AI themes out there as well, which don't belong, of course, on the small caps, the Russells, which is why you've got the underperformance in the Russell right now of negative 0.4%. As I say, the equity story, we'll build on that in just a moment. I want to sit on the bond market for a second as well. I can't believe how little this has been talked about. For 10 straight sessions, yields have been climbing higher at the front end. We're up by 5 basis points now in today's session on twos. So we've gone 50 basis points higher, Tom. 50 basis points higher in 10 days.
X sessions, I mean, John slides in the door at 5:52, but I get in a little earlier, and the 10 charts I look at are the same thing, John, as the 2-year yield. 3-month LIBOR up X number of days in a row, out to a new high this morning. The 30-year mortgage popped yesterday, way above a 7.04. It's not through to the new highs, but that 2-year yield observation, which I totally agree with you on, goes over to all sorts of other yield studies.
And spills out into other asset classes as well. So you've got this story of high yields eating into the rate cut story in the near term, breathing some life into the US dollar again. And this is the move. This currency pair against the euro has come down from pushing 111 all the way down to about 107 this morning. The lower the session, Lisa, 107.14. Right now, 107.28.
If it's hard to get macro themes, it's just as hard to get micro themes sometimes. And I think that that's what some of the share price moves that we've gotten today really highlight. You were talking about NVIDIA, John, and honestly, this share move might be the biggest in terms of an increase in market capitalization in U.S. history if it holds at these kinds of levels, surging 28%. We've talked about it all morning. The key question here is, do we have a sense of how many people are flooding back in after having missed it all of this year? Is this a moment of FOMO? Best Buy also a winner, up almost 5% after beating expectations. Their first quarter adjusted earnings per share 115 versus the 111 estimate. So again, a pretty big move. But there also are losers. And what the losers highlight to me, particularly with Snowflake, is that even within an industry, it is hard to make an accurate prediction. Snowflake has software tied to cloud computing, and it cut its guidance. So you see those shares down more than 13%. Cloud computing related to AI. And yet still not necessarily getting traction. An American Eagle down more than 18% after cutting full year forecasts. To me, again, the retail segment, you have the haves and the have-nots. But this is to me, inflation was really crimping some of the lower end kind of discounters simply because they did not have the capability to offset it with price increases.
Tell me a story, I'll validate it with a retailer right now. Whatever the story might be, you can find a name, can't you?
But that's exactly the point, right? So if you're having trouble understanding the macro, good luck with the micro, because it basically confirms anything and everything depending on which one you pick.
Good luck setting policy. We had Fed minutes yesterday, more Fed speak today. Richmond Fed President Tom Barkin, Boston Fed President Susan Collins coming up a little bit later. Kathy Jones of Charles Schwab has this to say on the Fed speak at the moment. Dallas Fed President Logan compared navigating the current need for tighter policy with the risk of financial instability to driving down a foggy road. My concern is that the Fed is trying to do this with one foot on the brake and the other on the gas. It seems like we could be in, Tom, for a very bumpy ride, if that's the case.
And then this is a study to the end of the quarter, June 30, I would say, is a study of what to do with QT. This is percolating out there in the zeitgeist, is, okay, what do you believe about QT? What should you do about QT? Joining us right now, Kathy Jones with all sorts of good work, including a dual piano from Eastman and Juilliard as well. Wonderful to have you here today. You emphasize something I'm very comfortable with, which is a barbell strategy given the Fed uncertainty John just pointed out as well. Describe what a barbell is and where the best barbell to lift is right now.
So barbell is just dividing the maturities of your holdings between, short and intermediate to long. And one reason we think a barbell makes sense right now, certainly tactically, is that you have a lot of pressure, obviously, on very short-term rates. You get a lot of yield there. That gives you some optionality with what to do in reinvesting. If you skip that, 2-3 year area that's priced for the Fed to cut, that's where you're probably vulnerable to a repricing if the Fed doesn't cut. And so, but then we want to go out longer because we still believe the narrative that the economy is going to slow and inflation is going to come down. So it's kind of a tactical way to kind of work in this environment.
Jess, she did that. She didn't give me how long out. Do I go out to 5 years or do I go out to 30 years? 30 or twos, 30s barbell?
No. No 30s. I would say, you could do up to 2, maybe actually a little bit less, stay more cash-like at the short end, and then 5 to 7, 5 to 10.
This is real bond talk about laddering out over risk of reinvestment.
If you give me 60
Serious
seconds, I'm
math.
going to do something to wind you up. Fed minutes yesterday. Wait for this, all right?
Skip.
Quote, several participants noted that if the economy evolved along the lines of their current outlooks, then further policy firming after this may not be necessary. Some participants commented that based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow. Additional policy firming would likely be warranted at future meetings.
Please go on.
I'm going to stop. Is some more than several? What's going on over there?
I don't know. Obviously, there's a range of opinions. I guess that's what we can say. I think that, but this does differ from the last couple of times when everybody was kind of on board with the anti-inflation narrative. We didn't hear a lot about, some or a few concerned about the lagged impact of tightening to date. Now we're starting to hear that narrative. So it sounds to me like there's a lot of people on the fence right now.
Well, let's say no action in June. Would your base case be the next move would be a cut or a hike?
I think they'd probably try to hold all year, but then next year start to cut.
Interesting. Go on, Bramo.
No, right now we're seeing this issue where July is becoming increasingly live. And this is different. And John, this is to your point. You were saying is the next move a cut or a hike. But right now people had been saying a cut. Now they're saying a hike. Is there a corollary for this level of volatility?
You could drive yourself nuts with all of this.
I am.
I get the sense now that you could come to some kind of compromise on the committee in the June meeting and say, let's skip June, let's get some additional information and make a call on July. And I think you might have some calls out there from people who say June, they'll probably skip, July, they're going to hike again. Now, the hawks out there, the hawks, if you can call them that, they're behind that idea, I think. I think they're willing to make that compromise. But this will come down to two things now. In fact, three. June 2nd payrolls, June 13th CPI, and let's see what happens with this debt ceiling mess. I can't imagine you get a rate hike if we're still trying to negotiate a debt ceiling mess and things get really dicey. What do you think we'd need to see June 2nd, June 13th to really put that hike back on the table and convince the several who think perhaps we should stop that maybe they need to go again?
Oh, I think it would come down to the size of the payroll increase, particularly, say, service sector payrolls, and then average hourly earnings. And you have to couple that with the work week. So what we've seen is the work week has slowed down, and that means that aggregate income starts to slow down. So even if wages are climbing, if people are getting fewer hours, that means writ large aggregate income is coming down. So I think they'll try to parse that pretty carefully. But I think you'd have to see a pretty big payroll number, above 250 again with some rising wages, and then a bad CPI number. That would probably put us back in the hike area.
How hard is it for the Fed to communicate not moving, not being necessarily indicative of rate cuts later in the year?
Yeah, I think that you could see that in the minutes, and you can hear that in their comments, very determined to say this is just a momentary pause, not a pivot, not a change in direction, just we're on hold for the moment, waiting to see. And I think they've really worked hard to communicate that, and the market's reflecting that.
Do you think that they have been successful in their communication and in a cohesive strategy that the market's understanding?
I think it's been a mixed bag, to put it nicely. I think communication has been fraught with a lot of a lot of reflecting a lot of different views, and maybe that's fine. Maybe that's the whole point, to get a lot of different views out there. But the volatility that we see at the short end reflects the fact, I think, that it's not clear to the market on a day-to-day basis where the Fed is coming from.
I am at Schwab. I'm down at Fort Worth for the Charles Schwab Challenge, the great colonial golf tournament, and I've got cash. I walk in the door today. Where's my most efficacious real yield? My most efficacious inflation-adjusted yield?
Well, when you're looking at, say, 5-year treasuries or so, when I look at the TIPS break-evens, or the 2 years, you got real yields are climbing. Well, real yields, they're climbing pretty fast. And so, if you look at, say, TIPS as a way to get real,
if you get over 150 on a 10-year real yield, what does that signal to you?
Yeah, I think that's a pretty good deal. Now, could go higher, but I think if you can lock in a real yield and have that nominal yield adjusted for CPI, it's not a bad deal.
You're on Friday for John's the Real Yield? Friday afternoon?
It's not John's anymore. It's not John's
I heard
anymore.
you're doing it Friday.
Am I? I haven't been told about that. Going into Memorial Day weekend. That was always a tough booking back in the day. Getting people to come in on 1 p.m.
What are you
Eastern
doing
time.
Memorial Day weekend Friday?
That was always tough. That was so difficult.
Yes.
Yeah.
I was always angling to get out the office.
Yeah.
That cough starts to come. Not that I would ever do that. Never done that. Kathy, thank you. Kathy Judge, the Charles as well. Well, that was great in COVID, wasn't it? Because, just that one cough, and it was like, whoa,
Yeah.
get out the
Stay
building.
away from me.
Get out the building. And now it's like, get to work.
Can I
Don't you
say-
dare do a test.
John, can I sell something?
That's happening at companies, right?
100%
Don't you
that's
dare
happening.
do a test.
Exactly.
If you do
Just
a
don't
test,
tell me.
you're out for 5 days. I do not want to know. I'm not saying that happens here. I'm saying it happens in other places.
My grandfather was a good golfer, and one of his heroes was a guy named Ben Hogan, who had a really tough childhood and basically invented the modern game. And he was in Texas, Fort Worth, Texas, which is very different than Dallas. And they have this itty-bitty golf course down there that's a jewel. I don't know much about it because I don't play golf. They had some financial difficulties. Charles Schwab single-handedly saved Ben Hogan's
Very cool.
Single-handedly did it.
Beautiful
It's
swing.
this weekend again.
Very cool. Get into golf now. Love that.
I was in it for years, but
for you.
full disclosure, folks, I don't play. So, I'm taking notes from you.
Story time with TK. Jim Nance. That would be cool on CBS, wouldn't it?
Should we recapitulate
We
Oak
can do
Hill?
that. Coming up.
What'd they call the
Well,
third
you've
hole?
got to say the name,
The
Brian
Poison-
Weiser. I mean,
Yeah.
Come on.
Brian Weiser coming up.
Coming up.
Guys,
Look
this is
forward to
crushing it.
in video.
Madison Moore on media and streaming. It's like that kind of cadence, right? We got this.
Yeah,
we got
it's,
this.
well, it's Thursday.
let's
We got to
hope-
get, by
let's hope-
Saturday, we're into it.
CBS is listening, Bram,
Oh,
just
yeah,
in
they're
case.
gonna pick room right up.
My goodness. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy's optimism that White House and GOP negotiators will reach a deal in time to avert a default didn't satisfy analysts. Fitch Ratings placed the United States AAA credit rating on watch. McCarthy said yesterday a deal is still possible before June 1st, and that's the date by which Treasury Secretary Janet Yellen has warned the U.S. could run out of money to pay its bills. NVIDIA is on track to beat Apple for a record single-day market gain. Now shares surging in pre-market after the company's bullish forecast boosted confidence that the chipmaker can keep thriving its business by focusing on artificial intelligence. If the gain holds, its value would rise by $219 billion to an all-time high of $974 billion. And that would top Apple's $191 billion one-day pop in November. Bill Ackman says Hindenburg Research has, quote, outed the way billionaire Carl Icahn runs his publicly traded company. In a lengthy Twitter post, Ackman also suggested shares have room to fall after tumbling Wednesday to the lowest level since 2009. He said Icahn Enterprises reminds him of Archegos, referring to Bill Wang's family office that spectacularly blew up in 2021. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
I would say all of the soft survey data, but predominantly the manufacturing PMIs, have tended to overstate and understate moves in the actual data in the economy, in the real GDP growth. The second thing I would say is that we're still facing, we're not entirely out of the bottleneck woods.
Very cool to catch up with Vasilios Giannakis there of Citi on the latest. Let's get to the latest price action in the equity market on the S&P 500 right now. Equity futures positive by 0.6%. Just a lift off the back of this, a major lift on Nvidia, up by about 28%. Just going to track this one through the morning, because if we get to about 32.4%, that's a $1 trillion market cap for this name. More than $200 billion in market cap added after some robust guidance. Can we call it robust or just blowout guidance? Just blowout guidance from Nvidia after the close yesterday. Just amazing.
Surge.
That market cap number, 755, that's from the close yesterday. So you've got to add on what we got overnight in the pre-market.
And John, this is critical. This is not a $1 trillion comparison to other $1 trillion companies like Microsoft. Those are ginormous companies versus Nvidia. The surge here in Nvidia, forget about overnight. In the last 3, 4, 5 years, down in the pandemic, it comes roaring back. It's a small company at $1 trillion.
In terms of revenue, yeah, I'm with you.
Yeah.
But in terms of growth, and that's what people are paying up for at the moment, I think the team here at Bloomberg did a great job after hours yesterday, really framing this. And if you are just tuning in, I'll share that with you again. Comparing it to the size of Intel, you've got this chip maker now, 6 times the size of Intel.
Love it.
And the company had more than twice NVIDIA's annual revenue last year. But it's about the future, I get all of that, and it's about the story of the moment, and which is why people are so interested in paying up for it, big time.
Yeah, and in the Intel issue is where you get humility involved, because a lot of us are on Intel, money forever, IBM, money forever, Sam Palmisano, free cash flow. Guess what, John? That didn't work out.
Didn't work out, I'm with you.
And that's a risk that you've got here. Why don't we talk to somebody expert on the strategy and the realities of media moving over into the technology, not so much on NVIDIA, but maybe on last night's stressful moment for Elon Musk. Brian Weiser joins us now. He's principal at Madison & Wall, and really a lot of experience of how you get there. And where I'm going to go, Brian Weiser, is I think it's called Twitter Spaces. Is that right, John?
Twitter Spaces,
Twitter Spaces. And what I would notice is the San Francisco Building Authority talks about the Twitter Hotel because Elon wanted everybody literally to sleep at the headquarters. Explain how you get to last night's debacle over what Elon Musk wrought over the last 12 months.
You know, it's always a surprise when you lay off almost all of your staff and the thing that you're building doesn't work, right? I mean, that's the thing. Like, that was why they had so many extra staff, for one of the reasons. I think it's as simple as that. They just don't have a platform that works at scale right now. That doesn't mean they can't rebuild it back to something more meaningful.
Okay,
I think
they can rebuild it back, but Brian, how did they get here? They should have known weeks in advance that if you put 200,000 people on John Farrow on Twitter Spaces, it's going to crash, right?
You're right. And I think that the problem is that we're seeing that Musk's ability to run an advertising business is not, let's say, particularly good. And I think that that's why the hope with Linda Yaccarino taking over there is that she'll be able to push him back. If he actually wants to have a thriving business, he needs to move away from the business and let her just run it.
The public discussion around Elon Musk and his Twitter adventures has been, wow, can you believe he's doing this? This is ridiculous. The quiet conversation among all the media companies is, can we cut people to that degree as well and still have a functional operation? That was really the feeling at a lot of media giants, and the reason why you saw a lot of proposed cuts in certain select places. How much is that a reality versus a fiction built out of hope? And yes, perhaps this is an extreme example, but with AI and some of the other tools, perhaps there's a bit of truth to it as well.
I don't know that there is. I mean, the problem is that technology begets the need for more people more than anything else. We've seen this in the world of programmatic advertising, which is driving so much of advertising. It's automating so many of the decisions that were being made to drive digital media over the last 15 years. It requires more people, not fewer people. It's why agencies have been so positive recently. It takes more labor, not less, to do a lot of the work in this world.
TV's difficult, Brian, I can tell you. Working on both sides of the camera, I know how hard the people work behind it. For me to be able to talk right now through the microphone, to be engaged on camera with you, for this to go out through radio as well. Brian, it's incredibly complex. If there was one person nervous last night, I think Governor DeSantis can break out and bounce back from this if he wants to. He'll go around and go on the media circuit, etc. If I was Tucker Carlson, Brian, watching this play out last night, would he be nervous based on what he saw?
Exactly. And I think that most media partners who require 5 nines probability of a platform working are going to be very reluctant to work with Twitter right now. Again, I think that this actually should arm Linda Yaccarino, I would hope, to push Musk to the side as much as possible. Because there are people who know how to build media businesses. They're just not at Twitter right now.
But Brian, it's also the audience question as well that I'd love your input on. This is an individual. Tucker over at Fox was just absolutely dominant in his hour. Multiples of other networks at times, pushing out 2-3 million people nightly. Brian, when I looked at the numbers yesterday, we were talking several 100,000, maybe at a peak 500,000. I mean, maybe you saw better numbers than I did, but that was what I experienced when I dipped in and out of the feed, trying to access it. What kind of numbers can the likes of Tucker Carlson expect to attract on that platform?
Well, I mean, the problem is Twitter will be limited right now. Certainly YouTube can handle millions of people at the same time. There's lots of platforms that can handle millions of people at the same time. Platforms that actually invest in infrastructure.
Well, but then what does this say in terms of streaming being the place for a lot of the new content and frankly, disintermediating cable, not just with sports, we saw that with ESPN, but also in the news, the direct consumer news business. How much do you actually see that becoming a probability, given some of the challenges, given some of the concern around social media being regulated like a media company?
Well, that's a separate issue, I think. Can you run a media business on a digital platform and have millions of concurrent users? Yes, I think we're seeing that works now. This isn't 10 years ago where that was a challenge. I think that for the bigger issue, for Tucker Carlson, for example, to be on Twitter, does that actually dissuade advertisers, probably, from participating? Does it raise risks around, various other forms of concerns for brand safety? Absolutely. But, I think that the technical issue is separate from the content issue.
Well, Brian, why does Linda address the technical issues then? Why is that the right how to do that?
Well, again, I think that she's not necessarily the person who's going to do it, but can she assemble the right people? Look, NBC Universal has a fantastic lineup of people working behind the scenes on the advertising business. I think they're really well regarded across the industry. And that's where I think a lot of the optimism comes from when you talk to people like me or others who know Linda or know other people from NBCU.
Well, Brian, I don't see Elon Musk saying anything about stepping back from that side of the business, do you?
He has not yet. He is not. You're correct. But I think the goal is that Linda needs to be able to encourage him to step back.
Okay. Okay.
I agree. The laughter is warranted.
You know, I just got a great idea.
Brian, can I put you on the spot? If you were still on the South Side and this stock was public, based on everything you've just told me, would you have a buy or a sell rating on it?
I think it's hard to imagine being positive about Twitter as a stock for equity at the current valuation right now. There's no way it's worth what it most recently was changing hands at in terms of what Musk was able to raise capital at.
Brian, thank you.
Bold answer.
Good to catch up. Brian Weiss there of Madison and Wool. Tough moment for that company. Tough.
What's interesting here is he said, you know, the basic idea is they hire her from NBC Universal and she brings in people as well. So let me get this straight. Elon dismantled it and all she's going to do is restructure it. I mean, that's pretty much the 3x5 card summary.
She also was an advertising executive, and it wasn't necessarily the technical expertise,
Well, she'll
but
bring in
also
the techies, right?
how do you get the advertisers back to a platform that's going through something of a changed identity, and at a time where there's sort of a question around some of the content.
He's got to
that's gonna
step
be coming up.
aside. I mean, as Brian said, there's no indication, John alluded to it, there's no indication Mr. Musk is stepping aside.
Everything
Twitter
I hear is that
back
she's
to
absolutely
Tesla.
phenomenal.
Totally.
And I think it says something about Elon Musk and the future that he's willing to take her on board. It's not really the type of hire that you'd make if you weren't willing to step back to some degree. You'd want someone you could manage. That doesn't look like someone to me that you can just manage and, you know, be the puppeteer and get them to do whatever you want. There's going to be some tension there, and clearly he's encouraging that.
Do you really think she's going to be like, I suggest, you know, maybe just, you know, over there, move
She
the chair over
strikes
there.
me as, I've never met her, but from what I hear from people who know her, that she seems to be a pretty straight talker. I don't think she's going to dance around it. We'll see how it develops. The magic of this is I have no exposure to it. I have no skin in the game. I'm a participant in the platform. It's not a public company anymore. The risk is on him.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very, very carefully.
Nobody covers business like Bloomberg, your global business authority.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
If you look at the valuations, they're still not where risk-reward is compelling.
When we're looking at the curve, we feel like it's mispriced. We feel like it's already pricing in a recession.
This is pretty classic late cycle behavior.
We're still seeing strong demand for particular services.
People are still releasing that pent-up demand from the pandemic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Thursday into the weekend? No, it is a very active Thursday with a sea change in technology. NVIDIA's the story. And John, moments ago, the NASDAQ 100, the NVIDIA 100, 2.05%.
Hey, well said. And you can bury the relationship between tech stocks and the bond market, because this is all happening, Tom, with 5% interest rates at the Federal Reserve and maybe even higher. Andrew Hollenhorst, the City publishing just moments ago, he's sticking to their long-held view that this Fed goes another 50 basis points, Tom, 25 in June, 25 in July.
Alluding to Bullard among the million speakers. We got more speakers today, right?
We do, a couple,
They're not on holiday yet. The government is, but not the Fed. And the answer here is it's based on consumption, based on jobs. And with claims coming out here in 29 minutes, there's still no indication of unemployment out there. I know when I say that, people get upset. I get hate mail. But the answer is claims look pretty good.
This economy right now is incredibly divided, Tom, worldwide. Manufacturing not great, services still robust. And you've got to make a call here. You're going to set policy for one or the other or somewhere in between. And at the moment, most people will tell you at the headline level, this labour market is still very tight, which is why that even if they do stop at 5, they've got to stay there. And that's where there is some consensus on the committee at the moment. Nobody wants to cut. They want to stay at 5, at least. Some people are thinking about going even further.
Yeah, and I would even link it into the stickiness. We talked about this, I think, yesterday or the day before. We were transitory a zillion years ago, and now it's the character of inflation in America, not the train wreck in Europe, but how sticky we are. And that means a better nominal GDP, which means better sales, which is how NVIDIA lights up on fire. And you just see it moments ago, Lisa, Ralph Lauren out. With some interesting numbers.
So this is the confusion of this year. We came into this year thinking that big tech stocks were interest rate sensitive, to John's point. We've learned that they're not. They're both safety as well as reach for growth. They're everything that you want them to be. You want it, we'll have it. That's basically big tech universe. Everyone's missed out. That's what you see in terms of mutual funds. Why would the Fed move away from tight policy, given the fact that suddenly the preeminence of artificial intelligence and the hope of technology increasing productivity is turbocharging expectations of growth?
Where you guys are better at this than I am. Where are we now in the parlor game of gaming rate cuts? Is that vaporized this week?
Well, I would say that this week there has been a feeling where we're pricing out a banking crisis. We are retracing a lot of those steps, and you're seeing yields on 2-year treasuries go back to about right before SVB
4.40
collapse. You're also seeing rate cuts being priced out of the market, but not fully. So we're not fully back there at a time when you're seeing NVIDIA blow expectations out of the water, and other companies like Ralph Lauren, like many others, do the same.
Zombie roll-up. This headline just out from the Wall Street Journal, and John Farrow's expert at this. Disney in talks to buy Comcast's minority stake in Hulu so that Hulu can sustain in the roll-up that we're going to see in streaming. How many streaming things do you have?
Too many.
So you can see F1 and soccer?
But Hulu is one. And
I don't have Hulu.
ESPN is a part of Hulu. And Hulu is a joint venture between a group of companies. Disney, of course, need to take out Comcast to then complete the whole effort. And then you do wonder what would happen with Hulu, what would happen with ESPN. Because at the moment you can get this deal where you get Hulu, ESPN and Disney Plus all together, all rolled up all nicely, and it costs you like $90-something now. without ads.
I can't cite it, but somebody said ESPN to ESPN Plus is a $20 stock pop for Disney. I mean, this is all interwoven, isn't it?
It's going to be interesting to see what they do. What's clear is that things have changed in the last 6 months in this whole industry in a massive, massive way. This big race to get subscribers, throw money at content, things have changed quickly.
Data check here because our guest is too good to be true. VIX 20 into 19.07 and NVIDIA lift.
Futures up, equities doing nicely, up by 0.7% on the S&P 500. Yields higher too, just on a 10-year to 374.58, but a move in a 2-year is where my attention is for a 10th straight session. Just higher a little bit this morning by a couple of basis points, Tom. 439.
Curve inversion, negative 65 basis points as well. It is wonderful to have Diana Amoa with us here, Chief Investment Officer of Long Base Strategies, Kirkenswald Capital Partners this morning. I want to go right to the pro discussion, which is you people say, be an EM, participate in EM. Every textbook, every paper says you have to hedge. To hedge or not to hedge is the core issue with EM. How do you hedge EM right now?
Well, if I'm assuming we're talking about hedging the currency risk here.
I go either way you want, but the answer is in financial media, nobody talks about this reality that you have to hedge EM.
Well, the reality is when you look at performance in emerging markets, it's actually been quite resilient. Two things that have been quite notable in the last few months: realized volatility in emerging market currencies and also in emerging market fixed income has been much lower than in developed markets. One can argue part of that is, one, inflation outlook in developed markets is much stickier, whilst in emerging market things appear to have peaked. But there was some support coming through from a weaker dollar in the first half of the year. So that's the reality, that emerging market right now, this year, if you'd hedged out your currency exposure, you'd have actually been regretting it, because for the most part, EMFX has done well. Where we are right now, I would say you still want to have EM duration. It's a trade that works in multiple scenarios of the world, irrespective of whether we have a recession in the US, whether the Fed cut rates or not. The outlook for emerging currencies, I think, for the next few months might be less clear-cut. But if you have a range-bound dollar, I would suggest actually maybe not hedging that.
Not hedging.
Yeah. Let's annoy some people, Diana. It's about 8 o'clock. They've had their coffee. They've woken up. They'll be really engaged now. When we talk about EM, are we talking about the US, the UK, Europe? Who are we talking about?
Well, typically people say it's the distress stories that you need to watch about. Where are we talking about default right now, John?
The US.
There you go. But, classic definition would argue, US doesn't qualify for an emerging market, but certainly what we're seeing right now with this default talk and the lack of consensus on how to manage the fiscal situation is raising some red flags and making emerging markets look relatively not too bad.
I have a simple EM test. I've had it for a long, long time. Goes something like this. If things get bad in that country, do you buy or sell the debt? It's as simple as that. Now, typically in developed markets, what you do when things get bad in that country, you buy the debt. Typically in EM, you sell it. What's happening with treasuries right now? Because I'm struggling with it. I know it's all at the front end, the bulk of it, but treasuries are selling off and have been for like the last 10 days. What's going on there?
Well, the thing that's interesting with the US market, you're seeing dislocations, particularly in front-end paper. Things that are going to be impacted by X date. So around the June paper, we are definitely seeing dislocation in pricing. And that's just a factor of the fact that there's no cross-default clauses in treasuries. So they can't technically default on a paper without it affecting the rest of the curve. And so markets are trading it that way. And the assumption is if you do get a technical default, it's going to be a short-lived story and actually might tip the economy into recession. So you're seeing this sort of inversion in the curve where people are buying some safe haven duration just to hedge against this outcome.
So for people who might consider some of the developing world emerging markets, some people on this set who might make that suggestion about the U.S., others would come out and say, what about NVIDIA? What about the tech giants that have performed really well? And they relate this to the bid for U.S. stocks, the bid for U.S. assets over the past decade as being a huge driver. How do you sort of play that story at a time when emerging markets have gotten bid up so far this year, and all of a sudden people are realizing perhaps there's something left in the U.S.?
Well, if you look at the performance in U.S. equities, I think there is a huge amount of dispersion within that. So it's not a one trade for the whole U.S. equity markets. I think it's specific themes that are more longer term and structural, things like the adaptation of AI, what's that doing to various companies and sectors. I think that's a theme that's here to stay. I wouldn't say that that means you buy the whole equity market, but you definitely look for some of these more resilient stories that are going to play out irrespective of whether we go into a recession, Lisa. And then from an EM perspective, most of these innovations are quite commodity intensive. So that's also another theme, whether you're talking about things like AI, electronic vehicle adaptation, the drive towards more sustainable sorts of manufacturing. That's a commodity theme that's going to be also a longer-term story.
How do you understand the valuation at a time when some of these stocks are trading like penny stocks, even though they have nearly $1 trillion valuation?
It's less about that than more about FOMO, in my view. So markets don't know what to do with equities. We've been talking about recession, going from recessions to default. People are jumping on the stories that look sustainable. So the valuations right now it's hard to say it's based purely on fundamentals and more about investors being underinvested in equity markets and not wanting to miss out on the winners.
If you look at all the cash out there, and I don't mean just, typical investment account cash, but private equity cash, just the ginormous amount of cash that's been raised, do you just assume it will float to equities? Or does it just stay like a brick in cash?
No, I don't think we're in that world where equities is the no-brainer play anymore, especially not when you have such interesting yields in fixed income. And I think for investors, that's probably the consideration, where whether you're looking at cash yielding close to 5%, or even duration in certain parts of the market. So there is money definitely on the sidelines, but I think the days of just buying equities blindly because you had easy monetary conditions are behind us, and investors will look at a much more balanced portfolio.
Diana, awesome, as always, and really good to see you in person. Diana Rameau there of Kirkus World Capital Partners. In many ways, central banks have had an easy life the 12 months previous because growth has been okay, inflation was too high. So what decision do you make? Well, you hike rates, that's easy. Yeah. So everyone sits around a table and makes that decision month after month for 12 months. Okay, then you start to get to the EM story that Diana's been talking about. Downside risk to growth, upside risk to inflation. Then you've got a tough decision to make as a central banker. Last 12 months, easy. You made the mistake. Guess what you've got to do? One thing, hike. What about now?
Well, right now are you restrictive, as Constant says at Mizzou, or are you super restrictive or that? What we know is we're not accommodative. And the trend is there. In Europe, this thing was underplayed this week.
Oh, the UK?
Yeah.
Governor Bailey.
It's just grim.
Oof.
Grim.
Let's see what they do.
Grim.
Jay Bryson coming up at Wells Fargo in about 20 minutes' time. Jobless claims drop in as well. Looking forward to that conversation from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The European Union has frozen more than $215 billion in Russian central bank assets since Moscow invaded Ukraine. EU nations reported the new numbers following the bloc's 10th sanctions package, which forced banks to divulge information on their size of their holdings. The EU wants Russia to pay for the reconstruction of Ukraine. Pressure is mounting on British Prime Minister Rishi Sunak on news that migration to the UK surged to a record last year. According to the Office for National Statistics, an estimated 606,000 more people moved to the UK than left. That's up from 488,000 the previous year. Sunak has pledged to limit the flow. A Chinese state-sponsored hacking group has steadily gained access to infrastructure organizations in Guam and elsewhere in the U.S. That's according to a new report from Microsoft, which says the group is likely trying to disrupt critical communications in the event of a crisis. Microsoft says the hackers, known as the Volt Typhoon, have been active since 2021. Guam has become an increasingly important military and strategic hub as tensions with China ratchet up. And today marks 3 years since George Floyd was killed at the hands of Minneapolis police. President Biden is marking the anniversary to urge Congress to enact meaningful police reform. In a statement, the president said he'll continue to fight for police accountability and urged lawmakers to honor Floyd's legacy. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
People ask me all the time, what is the key to being a really good investor? I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
The debt ceiling deadline closes
Back
in.
and forth on the debt ceiling debate.
Kevin McCarthy says it's going to be on the floor next week.
Keep it tuned to Bloomberg for up-to-the-minute reporting.
Movement from the White House walked out of this meeting saying the White House was being unreasonable.
And first-hand analysis from the political and business leaders who matter.
The debt ceiling is potentially catastrophic.
We will not pass a clean debt ceiling.
They should just simply do their job.
Both political parties are guilty.
For continuing coverage of the debt ceiling standoff, keep it tuned to Bloomberg, your global business authority.
You look again, Tom, at the polls. Americans want to see a deal, but they're very divided along partisan lines on what they think that should entail. And Republican voters think that spending cuts, they've bought the line that spending cuts are important, and Democratic voters have bought the line that its party is projecting.
Leslie Vinjer-Murray there of Chatham House on the debt limit talks. I don't usually like playing this game, but this game is pretty exceptional with this one name. Nvidia, up 30% in the pre-market. Wow. So this is a session high. And the game I'm talking about is the $1 trillion market cap game. For the number that you might be interested in, if you get to 32.41% higher, that is a $1 trillion market cap at this company. Now, this is interesting because this is not the normal $1 trillion watch. This is a $200 billion plus move in market cap in a morning, in a single session. And Lisa, historically, that is absolutely phenomenal.
Unprecedented, I think we could say. If this really holds, they're going to gain more market capitalization increase than any other company in the U.S. history, even Apple, even Amazon, even all of these behemoths that have proven themselves to be at the epicenter of American culture.
Intel, market cap. Do you want the market cap of Intel?
What is it?
120 billion. It's the market cap of Intel.
Well, yeah.
Think about what we're doing in the pre-market.
To be clear,
now.
NVIDIA's compared to Google, Meta and all the rest of them, and I get that, and maybe they're going to do more today. What the people would do, John, to your good observation here on how unusual this is look at the standard deviation move. And the weekly chart, which is maybe what the pros would use, not a daily chart, which is more inflammatory, it's a 3.6 standard deviation move up to where we are right now. In a $1 trillion company, I've never said that. What I am saying right now, in all these years, I have never stated that a stock would pop on a weekly standard deviation, 3.6 or 4.
Moves like that, Tom, are associated with much smaller companies, not companies this big. It's pretty phenomenal to see percentage point moves like that.
We'll continue to follow this. Of course, Bloomberg Technology with some really important perspective on this through the day. This is a joy. Douglas Holtz-Eakin out of the Princeton shop has done serious work on the debt and the deficit. I'm not going to demean him by asking him about Oval Office discussions or that, but I'm going to ask him about where we are. Of course, his work with the Congressional Budget Office and president of American Action Forum. Dr. Holtz-Eakin, I'm going to cut to the chase. You go where the CBO goes, which is to try to estimate our growth rates of revenues, which I think is called taxes, and spending. Where are those glide paths going to be after this debt crisis?
I think it's important to recognize that regardless of what deal is ultimately struck, it will put the tiniest of dents in our fiscal challenge. The fundamental problem is in the large entitlement spending programs. They're off the table. There's a room to raise more revenue. That's off the table. So we're not addressing the real issues that face the federal government and the budget. And honestly, until we get serious about slowing the growth rate of the big entitlement spending programs, the budget will never end up. They'd simply grow much faster than revenue ever plausibly will.
I mean, I look where we are, and we need a commission. So we need a commission with people with Z in their names. So I can really see Orszag Holtz-Eakin or Holtz-Eakin Orszag is an intelligent commission that Americans would know as intelligent people coming to an intelligent solution. And yet we're not talking about that. Why not?
This is politics. That's all there is to it. The issue is not the debt ceiling. The issue is not default. There's unanimity that we have to raise the debt ceiling. There's unanimity that we should not even come close to defaulting. There's a big disagreement about the future of fiscal policy. I think it's healthy that this has been highlighted to the American people. My concern has been that in the 21st century, we've never seen the debt do anything but go up, even relative to the economy. And there's never been the political wherewithal to stabilize it, which is, I think, the necessary condition for the U.S. And we really haven't talked about it. If you think back to the presidents we've had, I worked for George W. Bush. I admire him greatly, but his budget said, let's win the war on global terror. You look at the 8 years of the Obama administration, the only thing that they said about the federal budget that might be a problem is the rich didn't pay their fair share. The Trump administration said nothing for 4 years on debts and deficits, and the Biden administration came in with really enormous plans to just expand spending. And so the American people can be excused for not understanding we have a big problem, and we do. Well, but it's time they were told that, and that, addressing it is the thing that we have to do next.
And Doug, they've perhaps been told that, but as Leslie Vinjamori said of Chatham House earlier in the show, it doesn't mean that they're going to accept that they get less on any given day, that they're going to get fewer benefits. And there does seem to be a shift on both sides of the aisle to adding, whether it's respect to investing in technology, whether it's with respect to investing in infrastructure, or whether it's just the spending that we already have in place. It doesn't seem likely that we're going to see restraint in the near future, regardless of what comes from this budget. What's your view in terms of what it would take to make people truly care about a debt limit that doesn't really seem to matter if they could just kick it up and they can keep borrowing at relatively low rates?
They shouldn't care about the debt limit. I mean, there's no real economic rationale for having a debt limit. We're the major economy on the globe that has one, and it doesn't make any economic sense. They should care about the fact that the spending exceeds the revenues as far as the eye can see, and that leads to real threats. They should care even more about the fact that because the entitlement spending is claiming all the revenue, there isn't money for real investments. We're squeezing out national security, basic research, infrastructure, education, the things our founders saw as the role of government. And that's a serious problem for having a more prosperous future. And they should care a lot about the fact that those big programs are taking all the money and they're not financially sustainable. Social Security is going to go bankrupt in 10 years. Someone who's 55 literally can't plan their retirement because they haven't fixed Social Security. That's just unconscionable. That should wake people up.
What's your sense of the tax revenues? We've been talking about how bumpy and lumpy it's been and that it's been underwhelming. How much is this a lack of investment in the IRS and a lack of tax collection?
We've had a longstanding problem with the IRS. It's beyond merely the technology. It's an organization whose culture has been deeply broken, and so it is time to get the IRS back to its job, which is to collect the taxes and do it effectively. We somewhere along the line decided everything should be a refundable tax credit and turn them into a benefits-paying organization. They weren't built to do that, and they struggle with it. And so identifying its mission, getting it staffed up, giving it modern technology are all essential.
Great to catch up, Doug. As always on this, Douglas Holtz-Eakin there of the American Action Forum. Just waiting for some data in about 6 minutes' time. Jobless claims are coming out. Ahead of that, equity futures right now positive by 0.75%. And some breaking news on jobless claims. Mike McKee, we've been following this story closely, and you can put some numbers on it.
Yeah, there's been some feeling that Massachusetts was overstating the number of jobless claims because of fraud, and the state has now confirmed that. Over the past 3 months, about 14,300 jobless claims too many. So it drops the total number of jobless claims by about 171,000. So the data we're going to get at 8:30 is going to be significantly lower. and it is because of a fraud in Massachusetts. So it's going to be hard to parse out exactly what the jobless claims situation is for a while. Other states, including Kentucky, have also reported the possibility of fraud, which kind of raises a question about jobless claims in general and how valuable they are going to be as a predictor of the labor market at this point.
Help me here, 30 seconds. We went from 190 to 244 on a 4-week moving average jobless claims. Is Mike McKee adjusting the claims vector down because of one little state?
Well, the number of people claiming jobless claims that are fraudulent would adjust the vector down. Now, there was an adjustment up from the 190 because of seasonal adjustment factors that is still going to be in there. But it does look like, say, we had 242,000 last week, subtract about 14,000 from that, and it would look like a big drop.
245 is the estimate. I imagine if you had this information, you might make a couple of changes. The actual number is going to drop next. Get the analysis with Mike McKee in just a moment. The previous number on claims, 242. The estimate before this news was 245. The print up next.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg surveillance, Lisa Abramowitz and Tom Keene. We're adjusting here slightly our vectors this morning. Pharaoh went over to adjust the 9 o'clock vector. He'll be working on a lot of good stuff, including the opening of NVIDIA, which we'll see at 9:30 this morning. But we're looking at his claims. And if you're just joining us moments ago, Michael McKee giving us the great work of Augusta Sariva down in Washington over what claims will be. And so here at 8:30, it's a different claims report than a usual claims report because it's going to be adjusted. And Mike McKee's going to adjust for us right now the adjusted weekly data. Are you able to accomplish this feat?
I am able to accomplish this. It reminds me of the airplane. What's the vector, Victor? Right now, 229,000 jobless claims last week. That is down from the prior week's initial release of 242,000. But we've got to see here what the actual revision is going to be because, as we mentioned, Massachusetts reported fraud in its initial claims numbers. About 14,300 a week had been added in. So over the course of the last 12 weeks, that's about 35,000. Yeah, the revision now goes to 225 from last week. So last week, instead of being 242, was 225. So we actually go up by 4,000. If you want to figure out what that means for the economy and the markets, go ahead. I know Lisa was struggling to do that, but it does suggest some problems with jobless claims as a sort of canary to tell us something about the labor market.
Can we look at the second view of GDP numbers coming out, which I think is a sprightly report, which maybe is that market reaction?
Well, we do see that GDP, the second report, first revision, 1.3% for the first quarter. That is up from 1.1% initially reported, and it does look like a lot of that is consumer spending, up 3.8% versus 3.7%. We're going to have to check and see the details of that to see how much of that is inventories as well, which was a big deal in the earlier report. But it does suggest that we are seeing stronger growth in the U.S. than everybody had anticipated.
It's like the Bramo Memorial Day weekend plans. They're sprightly plans. Lisa, to look at the 2-year yield, 4.43%.
It's up.
I mean, it's up.
But it still is below the session highs. And I don't understand why it's not up more, especially given that we got downward revisions to some of the prior jobless claims. To me, there is a question of why we are still pricing in rate cuts by the end of this year.
I don't get it.
Albeit not that much.
I've never bought it for a minute.
But to me, if we do use these as some sort of measure, then it really signals an employment market that's chugging along just as strong.
And I'm going to go claims. You're right. That has some value. But for me, the second look of GDP, folks, is a big deal. I'm going to add 1.1 plus 4 is a 5.1 fake nominal GDP number. And that is adjusted to 5.5. I think that's a big, big leap here in that second look. And there's a third look that we get along the way. McKee's the only one that looks at that as well. But help me here with the animal spirit as seen by personal consumption ticking up in the second look.
Well, one of the big things is non-residential fixed investment, basically business spending, which had been very low, revised up to 1.4%, so a little healthier than it had been, and consumer spending higher. So overall, the economy going into the second quarter was running a little bit stronger than had been initially thought, which suggests that it may be not unrealistic that we see some reasonable growth in the second quarter. The Atlanta Fed GDP Now number, which is it's way too preliminary to put a lot of stock in it, but it has us growing at 2.9% in the second quarter.
Mike, how reliable are some of these data points, especially given potential fraud, potential revisions that have been all over the map?
Well, it does suggest that jobless claims around the country have an issue. We saw a lot of fraud during the pandemic, and that really pushed up a lot. I mean, we got 20 million jobless claims, and now they're saying maybe half that. So we really don't know. And a lot of these jobless claim systems in the states, we did find out during the pandemic, are running on very old computers, and they don't have a very good verification system. And states have chopped their spending on it, so they have fewer people to verify who are getting the benefits. And so it does call into question sort of the whole jobless claims shall we call it structure, a rather rickety structure. We did see continuing claims not revised. They were up 1,799,000 last week. This week, 1,794,000. So very little change in that does suggest that a few of those people fell out.
Right.
So we're not seeing a declining, deteriorating trend as we thought in jobless claims.
Michael McKee with us. He'll be in with us Saturday morning to discuss NVIDIA and the effect on the American economy. Right now, we get interesting GDP revision perspective from Jay Bryson. He's chief economist at Wells Fargo. Jay, do you get a lot of value out of a second look at GDP and, dare I say, the third look?
There's a little bit of value in the sense of what you get in the second release is the first estimate of gross domestic income. It's the income side of the national accounts. It should, in theory, be the same thing as GDP. I'm not sure what that came out as. So you get some of that. You also get corporate profits, which are also important for the economy. So, I look at more of the income side of things in the second look here than I do in terms of the demand components.
Jay, how data dependent can you be if you can't rely on the data?
Well, you're always flying blind in this economy, and I guess what I would say, Lisa, right now is there's a lot of choppiness, there's a lot of noise out there. I mean, I kind of the big picture here, I think, in terms of the economy is it continues to expand. It seems at call it modest pace at this point. The labor market, I think, in general, is holding in there, and I think we know that inflation has come down, but it remains kind of elevated, and so I think that's the real narrative that we have to manage to at this point.
Well, the narrative has been all over the place this year, as we all know, as we've all been trying to track, and I'm wondering whether this idea of immaculate disinflation moved to perhaps rapid inflation to suddenly now it'll slowly go away and we don't have to worry about it anymore. Is the market underpricing the risk of having to worry about inflation for a longer period of time, forcing the Fed's hand a little bit more?
I think, Lisa, that there's something to be said for that. I mean, if you look at market pricing, and you folks were talking about it earlier, at the end of the year, there's rate cuts priced in there. I think some way to make sense of that would be, the market isn't really good at making precise estimates of probabilities. One way to look at that is a low probability of a really big move by the end of the year because something has blown up, whether it's the debt ceiling or something else along those lines. But if that doesn't happen, then I think that there's a really good possibility that, or there's a possibility that you could get stuck at an inflation rate that's higher than 3%. And I don't think the market is priced for that, because I don't think the Fed would be cutting in that situation, nor would they actually probably be on hold. They're probably raising rates even higher.
Jay, the heritage of Wells Fargo economics, from John Sylvia to Jay Bryson, has just been brilliant on the demographics, the movement, the fabric of this nation. Do you believe in a rolling recession? I mean, we're aggregating in even to the silliness of an NBER estimate of this dreaded R word. But should we have a belief in a rolling recession, given all of the fractured parts of the American experiment?
Well, yeah, Tom, and I think there's, it depends what your definition of rolling recession is. I tend to think of one as hitting different sectors at different times. And so, if you look at housing clearly slumped last year. There's some evidence to suggest that's probably stabilizing. Manufacturing, at best, has kind of topped out. The thing that's holding in there right now is consumer spending. And, if you kind of go forward here, if you do have weakness in housing, if you do have weakness in manufacturing, you could see some job losses there, and then that could then bleed over into consumer spending. And so you could have not all sectors going down at the same time, but you could have this, as you talk about, this kind of rolling, sort of recession thing going on.
And you mentioned the smartest thing I've heard today was Lisa Abramowitz, our airline analyst on Delta Airlines. I mean, that's the single smartest thing I heard this week. It's completely ginormous, sold out, and that's personal consumption. And in one way, that's personal consumption.
It's absolutely personal consumption. It will consume your whole paycheck if you try to travel a lot. I do wonder, Jay, though, just going forward, whether we do see some sort of seismic shift coming down the pike for the U.S., given NVIDIA, given AI, given the tech giants that were left for dead, sort of, and then suddenly reprise their greatness this year. Do you think that this is a lasting trend that has implications for jobs, that has implications for gross domestic product?
Oh, yeah, absolutely. I mean, the way I think about it is AI is a potential productivity game changer. You know, it's another, you know, I don't want to get too dramatic here, but, you know, industrial revolution, you know, maybe it's not industrial revolution, but it's kind of like when we first went to the networking of computers and the internet back in the late 1990s. I think it's even bigger than that if it, as it comes along. You know, the issue, though, obviously, is not only is it a productivity game changer, it has profound social and political implications. And that's going to last for years and years and years.
Dr. Bryson, thank you so much for joining us. Brilliant. Jay Bryson there, Wells Fargo, parsing. Yes, claims, some news there. Thank you to our Washington team for that great reporting on Massachusetts claims fraud. These are markets on the move. The easy answer is NVIDIA and the NASDAQ, the NVIDIA 100. I like that. I get a royalty off that. NVIDIA 100 out 2.05% to 2.20%. And the dynamics that we're seeing with almost 4.44 two-year yield is the 2s10s vanilla spread finally moves with a vengeance. There's something going on this morning with this spike down, a greater inversion, and I'm sorry, 70 basis points is not the same as 60 basis points.
It's driven by the front end. People are pricing out the idea of rate cuts, pricing in the idea that the Fed's going to have to raise rates for longer. When it comes to the debt ceiling, we've been trying to, you know, touch on it with a sort of fork from a distance, but we do get some information on that. Kevin McCarthy saying that they worked well past midnight, negotiators trying to get a deal done. He said that there are a couple of issues remaining. He's speaking to reporters. We're getting these headlines, parsing the urgency of getting something done, the feeling of progress with trying to make sure that, you know, everyone can present something to their constituents that doesn't make them look bad.
Barbecue, backyard, hot dogs, hamburgers, Zweigel White Hots, Zweigel Red Hots, beer. I'll let the speaker pick the beer. You know, you gracefully get through Memorial Day weekend, and, you know, Tuesday, rather, there's a solution, right? That's how this is supposed to work.
Do you think they're all going to get together, have a barbecue?
Have a barbecue.
Figure it out? Like, just, can't we all just get
Maybe
along?
Sojourn to Delaware and see the
ketchup.
president. I think it's just, you know, case of Jenny Cream Ale, that would help. Right now, 4.43% on that important two-year yield. 2s10 spread, 69 basis points. Markets on the move. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy's optimism that White House and GOP negotiators will reach a deal in time to avert a default didn't satisfy analysts. Fitch Ratings placed the United States AAA credit rating on watch. McCarthy said yesterday a deal is still possible before June 1st. That's the date by which Treasury Secretary Janet Yellen has warned the U.S. could run out of money to pay its bills. Germany has suffered its first recession since the start of the COVID-19 pandemic. Europe's biggest economy saw first quarter output shrink 0.3% from the previous 3 months. That followed a 0.5% drop between October and December. The government says lower household spending on food, clothing, footwear, and furnishings was responsible for the weak data. NVIDIA is on track to beat Apple for a record single-day market gain. Now, shares are surging in pre-market after the company's bullish forecast boosted confidence that the chipmaker can keep its business thriving by focusing on artificial intelligence. Now, if the gain holds, its value would rise by $219 billion to an all-time high of $974 billion. And that would top Apple's $191 billion one-day pop in November. Singapore Deputy Prime Minister Lawrence Wong says the widening rift between the U.S. and China appears to be irreconcilable. At a speech at a Nikkei forum in Tokyo, Wong said the situation has become more dangerous amid tensions between the two sides, with the Taiwan Strait becoming the region's most dangerous flashpoint. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Days Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
The retail stock activity has been dreadful, right? I mean, if you look under the surface, retail companies' stock performance, all the cyclicals underneath, below the tech side of the skew to the index is just driving things in the ground and telling you the economy is slowing unconditionally.
Daryl Cronk, Wells Fargo, as was Dr. Bryson moments ago. We thank Wells Fargo for their best and brightest. These are markets on the move this morning in equities, bonds, currencies, commodities. Forget about your Memorial Day weekend. We got to try to get to Friday, 4 p.m. at first. Let me go simply say, in the tech space, we continue to advance with NVIDIA leading the way. We've talked a lot about it this morning. All you need to know is up 1.8% on NASDAQ 100, now up 2.25%. We had to medicate Bramo here in the last 4 minutes looking at the two-year yield. I've got an 11 basis point move on the two-year yield, and even that against a 10-year basis point rising 3.
Honestly, I was surprised that the move wasn't bigger at the outset when we first got this data. Basically, the jobs market does not seem to be cracking. We could potentially get a deal. Consumption good, GDP revised upward, and suddenly you're looking at a two-year yield that has to really price out some of the pessimism that came in after the potential regional banking crisis. Looking at real yields on the 2-year. This is inflation adjusted. They are the highest going back at one point 2009. So we're talking at suddenly people reassessing sort of what needs to happen from the Federal Reserve.
And there's a shift here, folks. It's not just a grind higher. We like to use the word grind. The 10-year real yield, 1.52%. And we heard earlier from one of our good guests in bonds that this is a resistance point. I think it was Giannakis, Vasilio Giannakis of Citigroup, where we're breaking out back into a higher range on some of these yields. Again, the 10-year, 1.52%. The headlines here, and I tell you, they look at the 10-year real yield on balance of power. Anne-Marie Horton and Joe Matthew are all over that. We're going to look at their neck of the woods. McCarthy says not everyone will be happy with debt deal. I would sit on that. That sounds like maybe he's finally telling people this is what we got.
Well, let's see if he can wrangle everybody together to vote for it, right? That's the key. Not everyone's going to be happy, but will they still press we accept?
They're going to work 24/7 on the deal, on the 130 days that they work during the IB. It's go with me on this, folks. But seriously, your balance of power tonight on the debt deal, and it seems to be moving here in real time. Again, the NASDAQ up 2.3%. Stunning. Some of this is consumption in America, and she is excellent on the consumption as seen in the second look at GDP. Jennifer Bartusch joins us now I hate this title. Lisa, help me here. Senior Packaged Food and Retail Staples Analyst, which means she's only expert on aisle 3, 5, 9, and 14 at a big box. What a bunch of baloney. She is wonderful on the state of retail. Conflate, Jennifer, Walmart to Ralph Lauren to Tiffany's to Dollar Tree. Sum them all together on the strength right now that you've learned on Retail America.
Well, look, what it really is a story about is people are descending into value. They're chasing value. And so wherever there's value, based on your perception, that's where retailers are doing well. So we're seeing, people trading down into essentials and saving money for splurges, whether that's experiential or travel, things like that. But the consumer is definitely behaving in a completely different manner than they were a year ago.
How much is this really evidence of a K-shaped recovery? And I keep going back to this, or a K-shaped recession, whichever way you want to slice it, simply because the higher end stores are able to raise prices and increase margins while the lower end gets crimped much more with much more price sensitive buyers.
It really is definitely playing out that way. When you look at the higher end companies, they are able to pass through, but even the higher end consumer is starting to trade into areas where they can save money. So you've heard Walmart talk about higher income households shopping for groceries at Walmart. I would hypothesize part of that is that they then still can have more of their discretionary income to spend on the bigger, more interesting things that they're interested in. But it is getting to be a harder and harder environment for anybody who plays in that value customer segment.
Jennifer, as we're speaking, we're watching two-year yields rise considerably on the heels of better than expected jobless claims, fewer than expected, a good downside surprise, a sense that the labor market is still very strong. What have we heard from some of these retailers in terms of the wages that they are required to pay people, to pay staffers, to keep their stores fully employed? Is this still a concern? Do they still have to pay up? Do they still not have enough labor?
It is, in fact, an issue where they don't have enough labor. It is a competitive environment for labor right now. And the pressure of having to increase wages on an hourly basis or an annual basis is just not abating. And so we've seen big retailers talk about investing in raising their hourly wages even more than they have been in order to stay competitive. Because you have to remember, there's a huge cost associated with turnover. When people leave, you have to hire, train, and it's often cheaper to pay them more in the short term than the long-term impact of turnover.
Jen, let's play economist now, retail economist, and that so much of your world devolves down to pretty skinny profit margins. And all of that starts with buoyant revenue, units, and price, which leads to nominal GDP. So on our show, we're talking about sticky inflation. Is sticky inflation and better revenue growth good for Walmart, or is sticky inflation bad because their customers are being harmed by it?
Well, sticky inflation is good when it's at a reasonable rate, and that's really the key. When inflation is consistent and it's in that 3 to 5% range, that's pretty easy for most retailers to manage, and it's pretty easy for consumers to absorb. But when it becomes sticky at a much higher rate, that's where it becomes a real challenge, because the retailers need to be able to provide value, and consumers push back harder on where they're actually spending their dollars.
Jen, thank you so much. On short notice here with Markets on the Move, Jen Bartasius with Bloomberg Intelligence, definitive on what we're spending our money on across America. What you need to know is a further lift to the markets, 2.29% on the NASDAQ 100, make that 2.27% on the NASDAQ 100. And Lisa's watching all the different maturities. And I guess we got to go with a 12 basis point, 0.12% move on the two-year yield, rounded up 4.50%.
This is the year when narratives go to die. And I will say that because I'm watching the NASDAQ tick up near session highs, despite the fact that you're seeing yields rise. Remember when this used to be the most interest rate sensitive area? It is no more. Now it is about growth. It is about, a good GDP revision actually is a very positive thing because that means more expenditures in AI and other tech investing. To me, I just take a step back. What do we do with this mess? How do we gut check it? Yes, we can see the Fed sort of not really having any incentive to cut rates. That's what we're seeing at the short end. We're not seeing the labor market truly cracking, if we can trust this data. But how much can we really get a sense of whether this is growth and basically a soft landing versus, basically the Fed being forced to do more to curtail some of this momentum?
Amy, throw that chart back up there right now. On radio, what you're seeing is a curvature to the NASDAQ 100. And this is convexity. It's not the convexity I use, but we're going to go with it. And I wonder, Lisa, if the curve that you're seeing up off an NVIDIA is a short cover. There's people out there that don't believe in the NASDAQ, and you wonder how they responded at 4 o'clock yesterday when Romaine Bostick said, you know what, this isn't normal. And are they out there covering their shorts, driving up in an accelerant manner the price of the NASDAQ 100?
There's that play, which I think is a really good point. Also, Goldman Sachs putting out this report today saying that active mutual funds suffered an unusually large underperformance of their benchmarks simply because they had been avoiding tech. It had been a story where yields go higher, tech suffers, tech sells off.
This is really,
it hasn't worked.
Really, really important. 3, 2, 1. Apple's underowned.
There's that play, which I think
that is something. Everybody's like, you're out of your mind. Have another cream ale. The answer is Apple's underowned by institutions.
I'll give you some data on that. The average fund, this according to Goldman Sachs research, is 15 percentage points underweight Apple, to your point, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta. This according to Goldman Sachs. So in other words, if there is an incentive to buy, Tom, you're not wrong.
Right.
This is really maybe what's going on as people feel like they're under-owning these.
Single best chart. It works on radio, folks. Stay with me on this. The 2s, 10s, vanilla spread, the difference in that moonshot 2-year yield, and even the 10-year a little elevated this morning, a higher yield, is 70 basis points. We have seen a plunge to further greater inversion, that oddity in the 2s, 10 spread. It sounds like it's time to talk to Ira Jersey of Bloomberg Intelligence, Priya Misra of TD Securities, Bob Michael over at JP Morgan, and other worthies out there on a shifting bond market. We're going to shift to this. We're into a Memorial Day weekend. No, we're not. Huge activity today and into tomorrow as well. We'll be with you tomorrow to continue to look at this bond market. And what's NVIDIA going to do for us tomorrow?
I think that you're going to hear some of the executives just cheering. They're going to be preparing for their barbecue with some extra special.
We'll have to see on that. Stay with us on Bloomberg. Good morning.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
This market is absolutely fascinating. Live from New York City this morning. Good morning, good morning. Equities mounting up. Treasuries at the front end kind of melting down. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, Speaker McCarthy signals more debt deal optimism. As some Fed officials are leaning towards skipping June, Nvidia is absolutely surging after saying all the right things. We begin with the big issue, comforting mood music, uncomfortable reality. House Speaker Kevin McCarthy still sounding optimistic.
I am not going to give up. We're not going to default. We're going to solve this problem. I will stay with it until we can get it done. But let's be honest about this. We have to spend less than we spent last year.
That's the optimism. Here's the reality check. Fitch Ratings warning America's AAA credit rating is under threat. The rating watch negative reflects increased political partisanship that is hindering reaching a resolution to raise or suspend the debt limit despite the fast approaching X-date. A spokesperson from Treasury responding with the following. The Fitch's warning underscores the need for swift bipartisan action by Congress to avoid a manufactured crisis for our economy. House Democratic Whip Catherine Clark blaming what she calls Republican hostage-taking.
This is not normal. This is a hostage situation. Speaker McCarthy and Patrick McHenry both admitted that avoiding default is the only concession they're willing to offer. And who has the GOP taken hostage? It's not the White House. It's not Congress. It's not Democrats. It's the American people.
JP Morgan's chief U.S. economist Michael Ferroli now putting the odds of going through the X-date at 25%, writing the following. We still think the most likely outcome is a deal signed into law before the X-date, though we see the odds of passing through that date without an increase in the ceiling at around 25% and rising. Let's get to the Bloomberg team, Anne-Marie and Kelly Dines down in Washington, D.C. Morning, Anne-Marie.
Good morning, John. We're just getting some latest headlines coming from the Capitol. Speaker McCarthy, he is one that is going to be staying here, working through the weekend, while members of the House are actually going home for Memorial Day weekend. First thing he says about that Fitch ratings watch, he's not worried about it. He also said that he's told his negotiators to be working 24/7. I imagine, Jonathan, the people you speak to on Wall Street were already hoping and expecting their legislatures to be working 24/7, because we are now just 7 days away from June 1st, which is the date Treasury Secretary Janet Yellen says could be a highly likely date that could be the start of approaching a default. So Speaker McCarthy, though, yesterday did say he thinks potentially in principle we could get a deal this weekend. And let's just see what happens today. I'm sure there's going to be another meeting, given the sources I'm talking to at the White House and the Speaker saying himself he has these negotiators working 24/7 around the clock.
Kelly, there are a lot of people in this market that couldn't care less about ratings that come from credit rating companies. Should we care about this?
Well, we have to remember what happened in 2011, John. That debt limit impasse ultimately resulting in the S&P Global Ratings downgraded the U.S., losing the AAA credit rating. And we know what happened in the market at that time. Yes, there was a bit into treasuries, but there was turmoil within equities. So it raises the risk of something like that repeating this time around. Now, this rating watch negative from Fitch and also a warning from DBRS Morningstar specifically references political partisanship, the idea that we are rapidly approaching the X date, and yet the debt ceiling is not being lifted or suspended. So it raises the point that Treasury Secretary Janet Yellen has made repeatedly, which is the risk isn't just getting to the X date, it is also getting too close to it and something like this happening. I would note, though, that you see pushback against the idea of the U.S. actually defaulting, even if we get past the X date, the idea of prioritization, basically that the Treasury could continue to make some payments, like importantly payments on interest to bondholders, and not make others. Treasury Secretary Janet Yellen, though, has pushed back on that, saying prioritization is just default by another name. Ultimately, though, John, it comes down to what the credit rating agencies think about that.
Anne-Marie, can we just finish on substance? You and I have gone back and forth on this over the last couple of weeks. Ignore the mood music, the headlines, optimism, pessimism. Where are they making progress?
Well, it does seem like as of yesterday, what we heard is the biggest issue, Speaker McCarthy said, is just on spending. So it's always been, Jonathan, from what level they cut and how much they would cut. Remember, Speaker McCarthy continuously says they need to spend less next year than they did this year. The Biden administration says they're happy to spend less, but they need to also see revenue raises. We're still waiting on the exact details of what this spending potential cut could look like, and that has obviously been the biggest issue we are waiting on. The other thing we should note is that Speaker McCarthy this morning, talking to reporters, also said that not everyone is going to be happy with the deal. And I think that's pretty obvious. There's going to be some individuals on the progressive side that are really going to be upset, and already we're hearing it, upset with this White House. And then also those on his right flank that are going to think potentially they gave in too many concessions to the White House to get this deal done.
AMH, Kelly Lyons, to the two of you, thank you. For all the talk of doom and gloom down in Washington, D.C., look at the equity market. Futures right now up 1%. Look at the bond market. There's no rally in treasuries. They're selling off. Yields are higher by 9 basis points to the front end, 447. Let's talk about it with Invesco's Mo Hagbin, PGIM's Lindsay Rosner. Lindsay, can we just start there in the treasury market? Why are treasuries selling off for 10 consecutive days at the very front end on a 2-year?
Well, I think it's exactly what we saw this morning with economic data. The data continues to be strong. We've got a really strong GDP number. Next up in terms of importance would be NFP. But we are seeing a strong economy. And then you marry that with the Fed speak that we just got that said everybody really wanted to hike. And that June now is pricing in a 65% chance of a hike. So it seems like the Fed is not done. The data is encouraging. Hopefully we can get through this debt ceiling, and happy to talk about that more. But the big picture long term is that inflation's sticky, economy's strong, and the Fed pretty much is telling us they're going to have to go again.
This from Bank of America in my inbox just moments ago, seconds ago. Don't be so negative on corporate America. Mo, I understand that you're cautious on cyclical assets. Can you walk us through why?
Yeah, good morning, John. So, as you know, we've been defensively positioned, but actually in this market, that's actually paid off quite well. So, growth today and really just the rest of the year, we feel very strongly that, growth over value, and that's really a defensive play, but also market cap, right? We tend to be a little bit higher on the market cap relative to benchmark, and we see that outperformance in large cap versus mid and small. That said, the macro backdrop, I think there's not, it's not all roses and sunshine. Economic growth is slowing, and investor sentiment or risk appetite in the market has been also falling for the last several months. If you kind of look at what's happening with mutual fund flows, for example, we see incredible defensiveness, very conservative asset allocation across the board, elevated cash positions, $5 trillion in money market funds, almost $1 trillion in flows going into money market funds. And that's not even talking about bank deposits, which are very elevated at $17 trillion. So, investor sentiment still hasn't really caught up with what we're seeing with the market, especially today. But we're pretty constructive overall, right? We don't see an issue around kind of a hard landing. We would still be in the soft landing camp. And we are in a multi-asset context, very favorable in the bond space, right? So thinking about locking in yields and going out on the duration curve.
Well, let's talk about cross-asset. Mo, over the last few months, we've just been eating consensus positions alive. Year-to-date, tech is ripping. NVIDIA on my screen is up 29% in the pre-market. No one like that to start the year after a dreadful year last year. You look at the US dollar, the FX market, everyone wanted to get short. Then all of a sudden, dollar strength starts to come through with aggression in the last couple of weeks. We've come down from 110.95 all the way down towards 107 with a potential break of that in today's session. You see this repeatedly, cross-asset mode. Why is all that happening? And how much of that is left to push back against in the FX market, in treasuries, as we start to eat out those rate cuts that were priced for the back half of this year?
Yeah, look, I think the forward curve still suggests cuts, so that's a very interesting dynamic. You know, I think to Lindsay's point, we might have another hike, in our near future, and potentially, a pause. But cuts this year seem kind of hard to believe, just given kind of financial conditions and what the markets are doing. To your point, though, it leads us to believe that investors need to be a bit more dynamic, a bit more tactical in terms of their positioning relative to the past. You always have your strategic asset allocation and you position portfolios for the long term. But with this type of market, you also have to be flexible, and we're seeing that today.
Well, let's talk about what's happening today elsewhere. And over the last 10 days, treasuries have been selling off. Lindsay, I mentioned that to open the conversation with you. Do you worry that maybe treasuries have lost some of those risk mitigation qualities going into what could be a debt ceiling mess? Does that concern you in any way, shape or form? Because for us on this program, the number one question over the last month or so going into these negotiations was, would treasuries rally if things got messy down in Washington, or would they do something different this time? Would they sell off because of the inflation backdrop? Lindsay, how do you feel about that question now?
Yeah, I think it's about segmentation in the curve, right? So what we're talking about in the debt ceiling, and John, you and I, Jonathan, have talked about it before, which is front end of the curve, the T-bills in the very beginning. That is not a game worth playing. And in fact, those are up 100 basis points or so since we spoke last. So that's not the area that I think you want to think about in terms of correlations and is that safety. But as you go further out the curve, treasuries are the risk-free rate. And we started the top of the hour, there was a discussion about the potential downgrade. That downgrade can happen, by the way, without default. It can happen with prioritization even. So you have this dynamic where maybe the U.S. can be AA by 2 rating agencies, and then from our perspective, from portfolio construction, it's a AA. That being said, if you're in a backdrop where there really are problems, there's still going to be flight to quality. And the flight to quality is to a safe place, which will still be government securities.
So, Lindsay, does that mean it's still treasuries regardless of the rating? And I remember a conversation I had more than 10 years ago with Bill Blaine at New Edge at the time in London. And Bill was talking about the potential of a downgrade at the time. And he said, you won't sell treasuries, you'll just sell other things to make space for treasuries. Isn't that what's going to happen if this does indeed take place?
I think that's absolutely right. For example, when you manage some portfolios, you have an average credit quality minimum, something you have to maintain. And if it's portfolio side, actually the bonds you own in the portfolio, if you have a downgrade and you have notches lower in those treasuries, those mortgages, those agencies, your average credit quality obviously is weaker. In that environment, that's going to be a risk-off environment, right? If there's a downgrade to the U.S., you're going to want to fix your credit quality, and you're going to want to do that by selling lower quality assets. And for us, we've been really conservatively positioned in our portfolios. We are waiting for widening. And so I think that can lead to a really interesting dynamic where you got maybe triple B's widening. And then we'd go and pick up our favorite names and take advantage of that. So there are dynamics kind of on the margin that can happen if you do, in fact, have that downgrade. I don't think there's a massive forced selling in the fixed income market, but opportunities will be unlocked, and we want to be there to get them.
Interesting. Lindsay, you're going to stick with us alongside Mo Hagbin. Let's check out the price action right now. Equity futures near session highs, up close to 1%. In the bond market, yields elevated at the front end once again for a 10th session, up 9 basis points, pushing 450 now from 390 back on May 11th. In the FX market, dollar strength, euro weakness, 107.20. And then this one right here, NVIDIA, absolutely flying in the pre-market, up around about 30%. We're talking about adding $200 billion of market cap to this name. I can go through some of the morning calls for you already. From Citi, price target goes from 363 to 420. And they keep it very simple, Abby. They say 11 billion reasons to stay long. And Abby, a lot of people are long this name.
It is unbelievable, this move that we're seeing in NVIDIA, John. And I was just doing some math in the Bloomberg terminal since we're not able to use the SINS function right now. I believe this is going to be the best day because NVIDIA right now up 30%, going all the way back to March of 2020 when it was less than a $2 stock and it made a 42% move. We'll see on the open whether or not that's the case. But it has everything to do with that outlook, basically 40% better than what folks have been looking for, all about AI. And what makes this move so stunning is there had been a lot of naysayers, and I myself was a little bit skeptical. The stock has already doubled on the year going into this monster quarter. Just really unbelievable. Now, the AI that is really transforming the chip space and just the frenzy around AI and what it could mean, that's also helping AMD go higher. Google and Microsoft, we have those chip stocks, or at least AMD being a chip stock, but also Alphabet and Microsoft both also connected to AI. And then we have breaking news on Dish, another stock soaring here, John, up 21%. Wall Street Journal is saying that they're in talks to sell wireless plans for their through Amazon. This would help their nascent 5G rollout. Plans are not clear. The details aren't clear, but it could start as soon as June.
Abby,
stocks flying today.
Stock is up big time. NVIDIA, though, the standout. Thank you. Coming up, Fed officials, a split ahead of the June meeting.
It feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though.
That conversation up next.
Back in 1997, I was interested in the following question, which is there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms. Could actually act like a whip.
It feels to me that they're moving toward a pause. It doesn't surprise me that they're having a debate, though, because despite all these rate increases, the economy is holding up pretty well, and I think that's a bit of a surprise.
The latest Federal Reserve minutes capturing the emerging split on the committee. Several participants noting that if the economy evolved along the lines of their current outlooks, then further policy firming may not be necessary. Compare that to this. Some participants commented that based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow. Additional policy firming would likely be warranted. Governor Waller trying to make his position clearer. I do not support stopping rate hikes unless we get clear evidence that inflation is moving down towards our 2% objective. But whether we should hike or skip at the June meeting will depend on how the data comes in the next 3 weeks. So here's the calendar for the next 3 weeks. June 2nd is payrolls, June 13th is CPI, and perhaps a debt ceiling solution somewhere in between. Mike McKee has more. Morning, Mike.
Yeah, morning, John. Well, it was a very interesting set of minutes because, as you pointed out, there was a clear division between the some and several camps. First, let's define what that means. The Fed has code words for how many people are speaking about a particular topic, and according to a 2017 Fed paper, this in descending order is what they mean, and as you can see, some is more than several. Now, who is in what camp? That's a good question. We've sorted them a little bit here again. Put the sorting hat on again. And the team worried is Bowman, Waller, Kashkari, and Logan. The team paused Powell, Jefferson, Harker, Goolsbee. Now, there are more people in the worried camp, in the some camp, but the number of voters is exactly the same in both. And there are 3 voters who haven't yet really offered us their opinion. So we're going to have to wait to get a better idea of what's going to happen in June. And that is, of course, because we're waiting for those things that John just talked about in terms of a calendar. Inflation has just not slowed down enough is the argument that they're all making. You can see that in the red box there. That's core PCE, which we get tomorrow. It is basically flat for the last couple of months. And because it's not going down any faster, the question is, do you continue to raise in June, or do you wait and see what happens and possibly raise in July? Markets are pricing July now, John.
Especially after that claims print. Mike McKee, thank you. Mike broke down the claims number a little bit earlier. Downward revisions, 225 to the previous week. 229 is the new number now. 229, the estimate was 245. The previous number, 225. So 229, we're sub 230 on claims. Lindsay Rosner's back with us alongside Mo Hagbin. Lindsay, are we on course now for a skip in June and a hike in July?
I think a skip is hard, right? A skip is hard because how do you message that properly? If we pause and then decide to hike or decide to cut, every single time that there is a pause, there would be a question if there's going to be a reacceleration of rates. So I would argue that this is the most difficult, challenging time that this Fed has faced in terms of how to message and how to think of things. The data, as Mike said, is going to be crucial to tell us what they're going to do. I think we really need that data to have a better read. But as I mentioned, the market is pricing in a 65% chance of a hike in June, and that seems decently reasonable. And in the back end, in terms of what we're seeing for cuts, that's almost all been removed. 14 basis points only in cuts from here as of this morning. So really dramatic changes based upon all this speak, based upon all this data, and then you got the debt ceiling thrown into the middle of it.
And
so
let's see if we
it's an interesting time.
If we can escape the debt ceiling drama as well, you wonder how much upside is left in that conversation. Mo, you wonder how much upside is left to the tech story as well. I think that's what's interesting about what's developing in tech. At the same time, what is developing in the bond market. You've got this situation, Mo, where yields are pushing higher. We've got 5% rates at the Fed with the prospect of pushing them out further, maybe even up a little bit more from here. And yet you've got this monster rally in these story stocks around AI. Mo, are they names you want to stick with?
Yeah, so John, I think in an environment where growth is kind of below trend or kind of slowing down, actually, that is a very, logical place to go. Investors generally chase growth when growth is slowing, right? So in a way, that's a defensive story in our opinion. So looking at higher quality companies, larger companies, and moving away from the more pro-cyclical parts of the market, right? So your traditional small cap and value names seems to be, here to stay for a bit. We're positioned that way. We have been positioned that way since March. And, I think the momentum traders will start to come in as well, right? So if you think about momentum strategies last year, they had really kind of moved more towards that pro-cyclical side of the equity market. So value names, financials, some of the sectors that are maybe more levered to the business cycle, that's changed this year, right? With the NASDAQ outperforming, the S&P outperforming the Dow, and you look at small caps, you're barely in positive territory at the moment. So I think it stays that way for some time, and that's really more of a defensive positioning on the equity side rather than anything else from a sector perspective, in my opinion.
Hey Mo, appreciate your time. Mo Hagbin there, alongside the brilliant Lindsay Rosner. Thank you to both of you. Here's the price action right now. Big moves, up 0.8% on the S&P, absolutely flying on the NASDAQ 100, up around about 2.3% right now. Yields up and away. In the Treasury market on a 2-year, just fading just a touch, but still higher by 6 basis points, 443 on a 2-year. And in the FX market, off the back of that dollar strength, the euro against the dollar, euro-dollar 107.24, lower the session 107.14. That currency pair right now, 107.24, and negative about 0.2%. And the stock at the moment is this one right here. Nvidia is just absolutely amazing. The stock is up by 29% in early trading. I'm told that if we get to 32.41% on that particular stock in the pre-market, if we get to 32.41% higher, that means that market cap's gone from 755 billion to 1 trillion. So we're talking about $200 billion plus of market cap being added to one name off the back of the guidance from yesterday. Up next, the morning calls. I'll break down some of the calls on that name as big tech gets even bigger with a boost from Nvidia, delivering monster guidance and shattering estimates. That conversation up shortly with JP Morgan's Jordan Jackson.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Equities up nicely here, 5 minutes out from the opening bound. That's the price action. Let's get you some morning calls. First up, Citi, raising its Citi target up to 240, keeping it simple and writing the following: 11 billion reasons to stay long. That stock, Nvidia, up by 28%. Piper Sandler boosting its price target to 440, noting an unprecedented influx of orders associated with generative AI. And finally, Barclays raising Nvidia's price target to 500, saying results were at least a quarter early and extraordinary in magnitude. Coming up, Nvidia's blowout results fueling another rally in big tech.
in big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
We're 25 seconds away from the opening bow this morning. Good morning. About to add some weight to this rally year today on the NASDAQ. The NASDAQ flying at more than 2% going into the cash open. Equity futures on the S&P 500 positive as well, up by 0.85%. It's all down to one name in a moment. We'll talk about that one name in a moment. Let's see opening bow, switch on the board and get to the bond market. Yields look like this, higher by a single basis point on a 10-year. Up a basis point to 375.55. Big moves at the front end over the last 10 days. 10 consecutive days of yields higher, up another 7 or 8 basis points on a 2-year. 4.45. Coming with that, some dollar strength, euro weakness, euro dollar 107.20, negative by 0.3%, and crude backing away as well. We're down by about 2.7%, 72.40 on WTI right now. About 20 seconds into the session, equities positive by almost 0.9% on the S&P. On the NASDAQ, up by 1.8%. One stock to watch at the open, NVIDIA. Shares hitting an all-time high after delivering blowout results on robust demand for AI processors. The company inching ever closer to a $1 trillion market cap. Alex Webb has more. Morning, Alex.
Morning, John. Yeah, really quite extraordinary numbers coming out of NVIDIA. The expectation from the market was that the current quarter revenue would be in the order of $7 billion. The company's now predicting $11 billion. That's a 53% increase on expectations. This is all really coming from the nature of the way AI is being rolled out. It is being pushed by Google. It is being pushed by Microsoft for their cloud businesses. If you are doing AI stuff in the cloud, they say you need then to have the AI chips doing it. NVIDIA makes those chips. Demand is surging, and that's why we're seeing this sort of eye-watering $200 billion pop in the valuation today.
Alex, is it the size or the immediacy of their ability to monetize this emerging trend?
It's the fact that it is immediate, but there is expectation for quite a long tail. At the moment, we're seeing Google and Microsoft do this for the bleeding edge applications. There is huge expectation that this will go into all sorts of compute power over the next few years. There had been some concern maybe that there wasn't enough capacity at the foundries that actually make these chips, the likes of TSMC. The fact that they are able to ramp up production on the scale they're telegraphing today suggests that that is not a concern. They have capacity to make these, the supply is there, and the demand is clearly there too.
Adding some big market cap to this name in one session. Alex Webb, thank you, buddy. We're adding about $189 billion in market cap to one name in just a couple of minutes of trading off the back of all of this, and some big upgrades to the price targets that we've seen on the south side. Let's just go through them one by one. Citi, price target goes from 363 to 420. Piper Sandler, price target goes from 300 to 440. Barclays from 275 to 500. JP Morgan, look at that, 250 to 500. They've doubled their price target. on this name. Just a monster move on NVIDIA. Counts for about 5.5%, 6% of the NASDAQ 100. It's pushing the NASDAQ higher, pushing the S&P 500 higher by something like 0.6% this morning. It's almost boring to talk about anything else, but we got to turn to retail. Best Buy topping profit estimates and maintaining its outlook unveiled back in March. The company's CEO weighing in on the challenging macro environment, saying customers are clearly feeling cautious and making trade-off decisions as they continue to deal with higher inflation and low consumer confidence. Kaylee has more. Hey, Kaylee.
Yeah, John, a 3% move here at the open doesn't actually seem all that exciting, but Best Buy may be excited to see a light, if you will, at the end of the tunnel. The first quarter, they did beat earnings expectations, but comp sales were down 10%, and they expect they will be down up to 8% in the second quarter. As you said, though, they do stick to their full-year guidance, which is expecting a comp sales decline of no more than 6%, which suggests that they do expect that these declines will be moderating in the second half of the year. The company's CEO saying that they continue to expect that 2023 is going to represent the bottom in the decline of tech demand. Of course, they've really been struggling over the last year as consumers pulled back on discretionary spending for electronics specifically. And I would note analysts today sounding pretty positive after this report as well. Evercore ISI talking about how this is better than feared, considering they're sticking with the full-year guidance. And our analysts here at Bloomberg Intelligence also note that operating margin seems to be moving in the right direction, which could help the company meet its profitability goals. So up 2.25% here at the opening bell. I tried my best to make that exciting, John.
Kelly, you did. Of course you did. Of course. I mean, 3% on Best Buy compared to NVIDIA right now. Kelly, thank you as always. Let's stick with retail and the earnings from Dollar Tree, moving sharply lower after slashing its profit outlook. The CEO saying the following: while we're seeing early results from our initiatives, we're not immune to the external pressures affecting all of retail, notably the margin impact of elevated shrink and a product mix shift to consumables. Abby has more. Hey, Abby.
Hey, John. And we're now looking at the worst day for the shares of Dollar Tree going back to March of 2020, with this stock down about 16%. Now negative on the year. Coming into today, it had been up 10%, but now a decliner. And it has everything to do with their profit situation. Now sales of $7.3 billion, basically in line, but earnings of $1.47 missed by 4%. But more importantly, that's a year-over-year decline of more than 20%. A number of factors weighing here. Tough comps. It's really, again, that profit picture that's worrisome, though. The shift in demand to lower margin food, legal costs from a rat infestation at a warehouse, an increase in what's called shrink. That's basically a fancy retail word for losses due to stealing. So the messaging is consistent here, though, with what we heard out of Walmart and Target relative to consumers being tight, but especially around the lower income consumer, forcing U.S. shoppers to go toward food that's less expensive and also spend less on discretionary. The new management team, John, really has their work cut out for them.
Stock down 15% right now. Abby, thanks for that. Let's turn to higher-end retail. Ralph Lauren topping Q4 earnings estimates. The brand says it's still seeing strong consumer growth and acquisition despite declining revenue in both Europe and North America. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Ralph Lauren has pricing power. That's what you need to know. This was interesting. The brand increased prices by 12% for both the full-year and the fourth quarter. That helped to boost some of their earnings in the face of pretty sticky inflation, like you said, maybe some slowing sales. But let's get into some of the numbers, because fourth quarter adjusted EPS came in at 90 cents. The estimate was for just 60 cents, so a big beat there. Net revenue came in at $1.54 billion. Again, the estimate was for about $1.47 billion. So some big beats there, really coming back to those price hikes, and the company saying there could be more to come. Specifically, it said that it expects to continue to be able to raise its average retail prices in the current year. You can see shareholders pretty psyched about that. Currently, Ralph Lauren up about 6.2%.
Katie, thank you. Just to bring the audience an update on what we're hearing from Speaker McCarthy. House Speaker Kevin McCarthy speaking to a U.S. broadcaster, Fox News, a little bit earlier. This is what he had to say. Very difficult for Democrats to agree to spend less, although he did indicate that we've made progress on debt limit talks as of yesterday. He makes this statement that it's very difficult for Democrats to agree to spend less. Let's see if they can find an agreement. Right now, more broadly, this equity market is doing okay. As McCarthy says, we'll get this deal done at the end of the day. I think a lot of people still feel that way. Look at the bond market, Treasury yields higher by 7 or 8 basis points on a 2-year, 4.45. Just pricing in higher interest rates again. or rather taking out those rate cuts we'd priced for the second half of the year. As we do that, we start to bake in some dollar strength. The euro breaking down to 107.12. That's a new session low right now. Let's see if we break 107 on the single currency after coming that close to 111 several months ago. But this broader market, the lift we're getting is from one name at the moment, NVIDIA, absolutely flying. Dan Hives of Wedbush had this to say. He read the following: NVIDIA gave jaw-dropping, robust guidance that will be heard around the world. For any investor calling this an AI bubble, we would point them to this quarter, cementing our bullish thesis and speaking to the fourth industrial revolution now on the doorstep with AI. That was well-known tech bull Dan Ives. Here's what else we've heard recently on Big Tech.
Technology is fantastic, but also, as we know, these biggest names are driven by the excitement for AI. The tech trade has been in the largest cap techs.
As you look out more, 6 to 12 months, we think tech will continue to be leadership.
It's not really the whole NASDAQ I like. I like those components, which is in the AI and the ChatGPT.
As rates have gone higher, tech has done better. Technology is still bolstered by CapEx. I think that a crash scenario is probably unlikely.
More bond market stability might help things like tech.
We love technology.
Joining us now is Jordan Jackson of JP Morgan Asset Management. Jordan, I've got to start with this one. It's a difficult one for a lot of people. Are we on the brink of a melt up or a meltdown?
I think we're on the brink of a sideways market. I don't think that I'd like to see broader participation from the rest of the market. We certainly have continued to see big tech continue to hang in there. But I think more or less markets are pricing in this softish landing, right? This idea that the economy can avoid a recession amidst higher rates, amidst tighter banking conditions. But I think I struggle with sort of the fundamental story here. I still think earnings outlook still looks too optimistic from our viewpoint. And when I think about fundamentals and where the rate markets are currently pricing in their expectations for Fed policy, I struggle with the current valuation on the market as well. Obviously, the debt ceiling adds another layer of uncertainty. And so I think we're in store for a pretty sideways market. Now, this doesn't mean that big tech can continue to rally. I think that story continues to be much more of a micro story, right? Recognizing that tech continues to be fairly profitable, surprising on earnings, generally speaking. And so that suggests, maybe there's still a bit of legs. But as I look out maybe 6 to 12 months, I think fundamentally and maybe the valuation component becomes a little bit more challenging.
Well, Jordan, right now, though, to call that a micro story, it makes up a major chunk of the S&P 500. Can you really bet against that?
So look, from a price standpoint, right, when tech sneezes, the rest of the market is going to catch a cold. It's just because of the sheer weight. But again, we like to see when you look at the relative performance of the equal weight index relative to the S&P 500 more broadly, market cap weighted, that's severely underperformed. And that tends to, for me, I struggle with the durability of a broad, sustainable rally. And again, I think this will start to move towards a more macro story as you get further potential, at least less tightening from the Fed. More cautious potentially from the Fed, and that may be signaling a more severe recession. And I'm particularly worried about some of the stresses in the regional banking sector, and that broadening out to the broader economy, leading into a recession. Remember, tech may be leaning a bit more quality these days, but it's still cyclical. Right? And so if you get that recession, then again, I think you'll start to see some pressure in big tech.
Talk to me about what you think the relationship should be between what's developing in the bond market and equities right now, and how you would characterize how it's played out recently. Because right now on my screen, yields up, stocks up. Is that going to change?
Well, it's interesting. The risk-free market, just looking at the yield curve, is signaling that recession, right? It's signaling that economic slowdown. And when you look at credit markets within the bond market, they're also more or less in the camp of a soft landing, similarly with equities. With the exception of bank spreads that have really gapped out, the rest of the credit market spreads still look fairly tight. And so you're in this environment in which I think the risk-free markets are pricing in that recession. Risk assets are not. They're still pricing in that soft landing. And it will be until we start to see some of the hard data come through that suggests that the economy is in fact weakening, that you'll start to see that macro story take hold. And I think you'll see a bit of volatility, choppiness in risk assets.
Jordan, where we are seeing weakness is abroad now. The data surprises out of Europe, ugly. Some of the data out of China, disappointing. Do you see any durable tailwinds in the rest of the world equity market story that so many people got bulled up on coming into 23?
So I guess my sort of out of consensus call is maybe some tactical upside to traditional energy and oil prices here. I think you're seeing domestic demand from domestic consumers coming from China fairly weak. And I think from that perspective, China is going to go into its old playbook and start to build out some of the fiscal stimulus and boost some of its fixed asset investment to try to boost some of its GDP numbers over the next couple of quarters. Also, if you look at sort of OPEC Plus, they've already announced some production cuts. And when you look at economies like Malaysia and Nigeria, for an example, they've been underproducing relative to those production quotas already. And that sets up a backdrop of lower degrees of inventories. And the last point that I would make is I've been somewhat surprised that the U.S. did not take the opportunity to rebuild up the SPR. And so we could be very well entering into a period in which demand sort of hangs in there, but the supply side becomes a bit of a challenge. And that could be a bit of a tailwind to oil prices.
Well, based on prices right now, they might have another chance. Jordan, thank you, sir. As always, Jordan Jackson there of JP Morgan. Crude right now back in by 2.8%, WTI 72. That's not the price you want, I know, so let's get it on the screen. NVIDIA flying. 378 at the moment in early trading. We are higher by, what are we now? Up by about 24% on NVIDIA right now. Coming up, Governor Ron DeSantis and his big announcement, not going to plan.
We're just trying to get it going because there's so many people.
It's unfortunate. I'd like to never seen this before. Governor DeSantis for this.
That conversation up next.
Top names in business are on Bloomberg.
America and China have a lot of common interests: climate, nuclear proliferation, anti-terrorism, global stability, and we have differences. We're capitalists, they're not, and it's okay. We could sort it out, but we need to keep the Western alliances together, not just around war and Ukraine, but around strategic economic relationships, including trade.
Nobody covers business like Bloomberg, your global business authority.
DPDHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion
per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Governor DeSantis choosing to make his big announcement on Twitter.
Now it's quiet. All right, sorry about that. We've got so many people here that I think we are kind of melting the servers, which is a good sign. Thank you for putting up with these technical issues. I think we're definitely breaking new ground here. As far as I know, no major presidential candidate has ever announced their candidacy on social media this way. Certainly in a Twitter space. Steve, do you have a comment or question? I think you just need to unmute. If Steve can unmute, then we'll go ahead and ask him for a question. If not, we'll keep rolling here. All right, 3, 2, going.
I'm there,
all right,
guys.
sorry, Steve.
I'm there, guys.
Oh, there you go.
he is.
All right.
Yep. My bad.
Audio feedback glitches, accidental muting. Florida Governor Ron DeSantis looking to make the most of the difficulties.
We had a huge audience. It was the biggest they'd ever had. It did break the Twitter space. And so we're really excited with the enthusiasm.
Let's get to the team coverage. Bloomberg's Anne-Marie over in Washington alongside Mandeep Singh here in New York. AMH, how did that go?
Well, the New York Times called it a conference call from hell. And then, Jonathan, I know you at points were also listening in, and it was frustrating, right? Because you wanted to hear from Governor DeSantis, this highly watched candidate. Everyone's been waiting for him to make this announcement. It was supposed to start at 6 p.m., all these technical glitches. He didn't actually say he'd be running for president till 6:26 p.m. So obviously some frustration, I imagine, with those that were trying to listen in. They're spinning it as he, quote unquote, broke the internet. I think it remains to be seen what happens next. They were able to bring in about $1 million following that announcement. And right now for that DeSantis camp, it's going to be all about the fundraising. How much are they going to leverage all of this, him entering the race, and potentially where this goes from here? Because, Jonathan, one key aspect that he definitely wanted to try to really come across yesterday is that he could be like Trump, but without the drama, obviously without really talking about the former president. The issue is the former president has doubled his lead on Ron DeSantis since March.
So bad it's good. That's one way of looking at it. So bad that it's good. We're all talking about it. The obvious predictable takes from a lot of people in the media, we've all read them this morning. You read some of that a little bit earlier, Anne-Marie. Mandeep, was it so bad it's good? For the platform, not for the candidate.
I think I've seen Twitter spaces with over 1 million users. So clearly, the number of concurrent users caused a lot of difficulties for the platform. But to me, this is just, them not rehearsing this and not anticipating this kind of scale when it comes to this particular event. Look, I think people will forget, especially what they're trying to do with this is to target the younger demographic and, outside the linear TV channels that candidates typically use. So to my mind, they're going to use this more and more, and eventually they'll get used to it. But clearly, in terms of the viability of the platform, we are going to see more of this in this election.
Anne-Marie, we've got 18 months of runway, if he wants it, to carry on campaigning. To Mandeep's point, and we talked about this yesterday, these things can be forgotten pretty quickly. They feel terrible the morning after, but ultimately, what's the plan from here? What is the campaign going to look like? And what's the difference going to be between this candidate and the front runner right now, former President Donald Trump?
Well, I think one thing was clear yesterday. They wanted to do something a little bit different, something out of the box. What really struck me is I think this would have been the first candidate since FDR that had said, asking Americans to vote for him, saying, I want your vote, and was not on camera. But shortly after that, he did do an interview with Fox News. So you could see that they're definitely going to, at some point, also incorporate traditional media. And I think probably, Jonathan, that's where you're going to see this go. They're going to want to reach out to some more traditional networks after this interesting Twitter Space launch.
Interesting is one way of putting it. Here's something that is genuinely interesting. NVIDIA. I can't let you go, Mandeep, without bringing this up. The stock's up by 23%. Mandeep, what are you telling customers, clients at the moment, friends even, about what's developing here?
Well, so I think it's for a good reason. The fundamentals are strong. And anytime you see a company expanding their gross margin at this scale, it's a clear sign of pricing power. everybody wants their chips. That's what's driving the demand. I do think valuation-wise, there's a lot priced in, but that's why, the results yesterday were a reflection of how good the demand is and how it is translating into their outlook.
Mandeep, as you said on Bloomberg Surveillance earlier, you could have said exactly the same thing last week. And then we saw the numbers overnight. Just amazing. Mandeep, thank you. AMH, tremendous coverage, as always, down in Washington, outside the White House. NVIDIA up by about 23% at the moment, with some sector price action. Here's Abby.
A wild sector action, John. We have the S&P 500 up just about 0.5%, but a lot of sectors either up or down more than 1%. Sticking with NVIDIA, we have the tech space up 2.9%, flipping between the best day since January or November of last year on that NVIDIA and AI strength. But to the downside, we have energy down 2%, and then we have lots of the defensive sectors, utilities, healthcare, and consumer staples, with yields soaring, investors not wanting those dividends, plus with NVIDIA and tech, who wants the safety. But let's stick with NVIDIA. I know we would usually look at a sector here, but on the year, up 158%. I got a little ahead over my skis the other day, or earlier, John, but this is the best year right now since 2016.
Market cap, $934 billion US. Your trading diary up next.
The hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you would be.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
26 minutes into the session, equity still positive on the S&P 500, the Nasdaq. That's the price action. Here's the trending diary. Boston Fed President Susan Collins speaking from Rhode Island, 10:30 Eastern Time. Costco reporting earnings later. Plus, we'll get earnings from the Gap as well. US PCE inflation and UMich sentiment survey will round things out tomorrow. And looking ahead to next week, US markets, of course, close for Memorial Day on Monday from New York City. That does it for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long skinny necks. So Apatosaurus is an example. They also had really long skinny tails. So I made a computer model that showed that in fact the tail of these sauropod dinosaurs could actually act like a whip, a bullwhip. Now the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
898, I won! Look for the winning number in Sari Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. But it wasn't enough. People didn't want just a handful. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking, and of course Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
Alliance, they say, is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 139, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19 they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded... Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and the one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Weinergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small and well, space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then it's where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away. Because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impacts we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, Most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
Just truly cross boundaries and borders with a second's notice.
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000!
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby and I'm interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok influencers. One of the last holdouts in the world of disruption, finance, is next in line.
Is no longer being held in secret offices in New York and Boston of
investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
Robinhood was started in 2013 by Vlad Tenev and Baiju. While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers who might be coming at this absolutely cold.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and write-off.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote unquote YOLO their entire